edition of the Energy Week podcast. We are back from holiday, vacation, world travel, whatever you want to call it. Ryan Ray alongside Dr. Energy herself, Ellen-Wald. Ellen, how's it going?
Everything is fantastic. I had a really awesome little vacation last week in the Wyoming, southeastern Wyoming, and I got to see so much cool oil stuff. Like, it wasn't part of the vacation, but you just drive around there, and I saw, I think in one view down the highway, I saw windmills, a coal train, an oil pump jack, and a fracking rig.
There you go.
So that basically fits my idea of an excellent vacation.
Well, there you go. And we got some big news while you were out. iTunes has updated their rankings. I don't know what you call them. And this show, they have 60 shows ranked. And this show is number 56, I believe it was, in the world or wherever they do this at. And so thank you to the listeners. And, you know, we can always go higher. I don't think we were opposed to going higher. We don't know. Everyone, when I got into podcasting, everyone kind of presumed that iTunes is like calling you up and telling you. I don't know how iTunes works. I don't think anyone really does. They'll send me an email. But ratings and reviews seem to be the most effective way. So if you want to get us up higher than the corporate elitists who are currently beating us out for the top spots, 5-star rating and review would go a long way. And we have an announcement to make, Ellen. We've teased this for a little bit now. So we have been talking about, for the better part of this year at least, putting on an oil and gas cruise. And essentially, it would be Ellen, myself, Josh Shelton. I think we have David Blackman tentatively, and Joe Dancy. I hate to say, I say tentatively because they have tentatively agreed, so I don't want to put them on the spot. But handful of good guests, and we are looking at doing a 7-day cruise, I believe it is, early next year, late March, early April. But here's kind of how it works. To make sure that this is of interest, we wanted to ask the people. So oilandgascruise.com, it's easy. Nate will link to it in the show notes, oilandgascruise.com. Go there, just leave your information. If we have 250 people commit, that's not the number that we need for the cruise, but 250 people commit, we will do the cruise. If they say, hey, I would be interested, there's something I want to do, then go sign up. Not going to charge you anything, not going to cost you anything. It's just your contact information, and if we get enough people sign up, we will go ahead and get that done. We are going to give this 1 month. So you've got 1 month to tell us that you want to go on a cruise and hang out. We're going to do a few panels. It's not going to be 7 days of oil and gas stuff, but we're going to do 3 to 4 sessions while we're on the cruise ship, and the rest of the time we'll be going to swimming or eating ice cream or whatever it is you do. So you got a month. oilandgascruise.com. It will be linked up. Let us know. We got to have your information so we can contact you if we go forward. And if not, then I'll just probably go on a cruise without the rest of y'all. I think I'm going regardless. But anyways, okay, Ellen, we have on Dr. Foreman today, and so that will be here in just a few minutes. Before we do that, we talked about this, I don't know, a little while ago. The Saudis are saying, hey, they are doing the IPO, and they've always wanted to do it this time, and despite the fact they said stuff completely contradictory to that. We talked about this a little bit on Texas Oil and Gas Podcast this morning. I know you have a piece here from Bloomberg that we're going to get to. Saudi-Aramco has to answer 3 tough questions, and that was on Friday, I believe you released that. They've had that call this morning, I believe. But one of the things I thought about over the weekend was this idea that if they are going to do their IPO in 2020 or 2021, the prices are soft right now, but they must think the price is going to rebound in that time period. Otherwise, it wouldn't be the right time to do that, I would imagine.
Yeah, I mean, I think that they always think that the price is going to get higher. And the truth is that right now, and they came out and said this as well, that I think we all know that the price right now is not reflective of supply and demand at all. It's reflective of some sort of weird conception of future demand. Combined with just general pessimism about the state of the global economy, which is not necessarily reflective of reality, which means that, we could definitely, last summer we had significantly higher oil prices, and we could definitely go back in that direction. One of the things with oil markets is you never know, and that's why it's so interesting to so many people. But what is interesting is it seems that they the company said they didn't say much on this call today. Honestly, it was like the shortest investor relations call of all time, probably, which
was it better or worse than an Elon Musk call?
Okay, so that's a really good question because like I was comparing it to my experience calling into the Elon Musk call. Nobody asked what kind of sunglasses the CFO was wearing. So I'm not sure if that makes it a better or worse call. I will say this.
Regardless, but go ahead. Sorry.
Yeah. I will say this. Okay, Aramco is not a public company. Nobody owns shares in it. It's got one shareholder. Okay, so all the people calling on were not people who invested in this company, who have been tracking this company, or have investments in this company. So, like, they never really explained why they were holding this investor relations call, seeing as they don't have any investors to relate to. But it was pretty clear that the people who were on this call were either there because it's August and they're bored, or they were curious. They didn't really know that much about the company. And I could tell that based on the questions that they asked. And as opposed to when you are on like a Tesla, an Elon Musk call, people really know what they're talking. Like people have really studied that company, and they ask really pointed questions about very specific aspects of their financials and their proposal and that kind of stuff. And this was more like, oh, your carbon footprint isn't so bad. Tell us about that.
Right.
Or your east-west pipeline that you're going to expand to, from 5 million barrels a day to 7 million barrels a day. When's that supposed to be completed again? And so there was one question that focused on the remotely interesting piece of information that they revealed, which had to do with the dividends that the company pays to the government. And they had in their very short 8-slide deck a comparison between how they use their cash in H1 2018 and H1 2019. And they made less money, in 2019. We know that they're still the most profitable company in the world, but they made less money. We understand that. Oil prices are down. They were actually producing less. So that's totally understandable. But their dividend was way up. That's basically like more money that they give to the government. And we kind of knew that based on stuff that the Saudi government had said about their own budget. But so one person kind of asked, like, how do you decide these dividends? And the guy didn't really answer so well. He kind of said, like, the executives and the board look at, like, is it sustainable? Is it, what did he say? I wrote this down. I'm gonna look it up for our podcast listeners because you deserve to know straight from the source. He said, is it sustainable? Is it affordable? And it's benchmarked. I'm like, what does that mean? I mean, we all know that the government is like, hey, we have a gap. We didn't get enough in taxes from you, so we need this much in dividend this year for our budget. So this is the kind of thing that, like, they did not answer, and nobody thought to press them on or ask them about. So it was you're kind of left wondering, like, what was the point?
Yeah. So real quick, Ellen has a piece here. Make sure to include that in the show notes that you just released on Forbes, kind of summarizing that. So if you want some more coverage of that, Ellen, if you remember way back when, before you came on the show as a co-host, this was in the news, and we were talking on the phone one day. And one of the things I asked you was, I said, I'm not really sure I'm not sure how devoted they actually are going through this process, but it feels like they don't really understand how to interact with the investors and the media over here. And I'm not sure they've got a grasp of it still, but let's say they go through this IPO. I feel like they're going to have a really hard time. Obviously they can show great returns and that'll cure a lot of problems, but I don't think they maybe fully understand. We've kind of joked on here before. I think it was last year, Exxon stock got devalued for basically the CEO didn't show up on the conference calls, what it felt like. Do they really fully understand what they're getting themselves into? Because right now it's softball. Right now no one knows, but there are people like yourself who are really tuned into this thing. And once they get on it, there's going to be some hard-hitting questions, and especially with someone like Saudi Arabia, where there's always a little bit of geopolitical tension that's going on as well.
Oh, yeah. I mean, you've hit the nail on the head, basically. That's the issue. And it was weird because, they had the CFO on, not the CEO. And it was like a really short presentation. I think they were expecting to have a lot more questions, or hoping at least for a lot more questions, because he kept saying like more questions, and no one was, pushing in. And what was interesting is that I think that there are those in the company who do have an understanding of how this stuff works and how it should work. But I think the question is, does the government understand that? And the more I learn about this, the more I think the answer is no, that the government really does not have a good understanding of this process. It's like they want this valuation, and they don't understand that when you put something on the market, you can hope for the valuation that you want. You can hope that they're going to offer it at, X amount per share, but you don't actually get to make that decision. Like the market is, and the banks are going to decide. And if you go too high and you push for too high a valuation, your stock's going to plummet on day one. Because if they insist for somehow on a $2 trillion valuation and the banks go along with it, which would be stupid, because then the banks would lose a lot of money, because they're the ones that okay. Maybe a listener wants to correct me on this, but from what I understand of an IPO process, and I talked to some, experts in this along the way, that my understanding is the bank, or banks in this case, because they need multiple banks, will buy all the shares from Aramco at a discounted price. And then they're going to sell them on the market at the price that they've determined that they think they'll make money at and that it deserves. Because the banks have to have some incentive to make money on all this. But say everyone's like, what the heck, I don't want to pay that much per share, then they're either going to be left with a lot of shares they can't sell, or they're going to have to sell them at lower prices, and the share price is just going to drop. And look what happened to Uber. Is that really what they want? And I'm not sure that even the price of oil could prevent that. I mean, if the price of oil is sky high, like $120 a barrel, then, people will just be buying based on the price of oil. But otherwise, I don't know. And I feel like they really don't have a good understanding of the fact that the prince can't just say, this is the valuation, make it so, and it will happen.
Right.
It doesn't work like that.
Yeah. And it's, there's plenty of companies who started out with, kind of opened up, and next thing you know, they've never hit that I'm looking at, a couple of tech companies right now that they opened up at whatever it was, $20, $30, $40, whatever, and change. And the next thing you know, they've never have recovered from that. And so it's going to be interesting to see how they respond to the first time where they get devalued, potentially unfairly, but it will change it will also change, I think, the scrutiny around the geopolitical stuff. That's even though it's not exactly a one-to-one with the government, it still will, I think, change that, and there will be questions that will be asked. And when there are deals that are being done, or wars are being fought, or ships being, all of those things, they're going to have to ask questions, rightly or wrongly, just because of the way that it's not like here where Exxon CEO is just Exxon CEO. He's not tied up with the government. Well, I guess Rex Tillerson aside, but he's not tied up with the government right while he's in that position. So I think that's gonna be tough for him to really get used to. And if you're an analyst and you're trying to position the stock a certain way, you can probably trip them up with some questions that either they don't want to answer, or they have to. And if they do answer, that's gonna make them look bad. So I think that it's gonna be a very much a chess game.
Oh, yeah. And I don't think that the CFO is going to be able to be on these calls if they're public, because, like you said, stock price can just drop because of that. And the optics are going to be, and the thing is that they have really good financials. They make a lot of profit. So when it just comes down to how much money they make, how much free cash they have, it's amazing. But for a company like this, that's not what it's all about. I mean, if they really, really, really wanted to do this the right way, they would go back to the way they would. So Aramco used to actually be a registered Delaware corporation until it was moved over to Saudi Arabia in 1988. They could do that. They could move back, go back to being go back to be an American company. That would make it if they really wanted to IPO the company and do it in a way that that really kind of eliminated that geopolitical government aspect, I think they could. I don't think they ever will. And
clarify this up. Clarify this for me, please, or bring to light this. Help me understand. The Saudi Wealth Fund. What percentage of the Saudis are actually dependent on that? Because the population, according to Google, is about 33 million. So what percentage is dependent on that?
So I think that 33 million also includes expats. I think Saudi population is more like 20 million.
Okay.
Like the actual Saudis.
Okay.
But yeah, so it's weird. There are a lot of ways that they're dependent on the government. So far, no one's dependent on the actual sovereign wealth fund because sovereign wealth fund doesn't make any money. It doesn't actually even have that much money still. But I mean, there are a lot of ways. Like it used to be that Aramco was paying for all their fuel, like literally all the fuel, electricity, gasoline, jet fuel, everything. Now the government pays Aramco back for that. And they've also raised the price, but they have like something it's called the citizens account, which is basically like a universal basic income for people below a certain level of income. And the government is the largest employer of the kingdom.
Well, yeah, and that's what I was getting at. Mainly is that we talk about how profitable Saudi Aramco is. They're basically supporting a whole nation. Exactly. But I don't know if investors will like that or not. But anyways, they are obviously profitable because they are doing that. Okay, a couple quick articles to get to before Dr. Foreman hops on here. From CNBC, oil jumps more than 3% on European stock draw, despite demand slowdown forecast. The demand around the world is coming to a halt, according to everyone, it seems, Ellen. We won't need oil. And I got to ask you this. I was listening to a show the other day, and they said that they believe that we think about oil storage in a unique way. They were saying that we think about oil storage and the fact of we talk about, how many barrels a day we're consuming, how many barrels a day we're producing, and then there's kind of that number. One thing they said is that if you actually take the difference and you were to measure how many days the world could survive off of that on that excess, it's only like 28 days or something. And they said that people don't really think about that. And I haven't checked the numbers out, but that's what they said, 28 days, and that's really not that much surplus as you would think. But I found that interesting and didn't know if you've ever looked at the numbers from that standpoint.
And
no.
Are they right on the 28 days? I don't know either.
That makes me like, well, first of all, that makes me like rather concerned about an impending zombie apocalypse. 28 days. I feel like it could be like a movie. That is 28 days of oil. Like what happens if something knocks out? We have 28 days of oil left.
Yeah, I haven't got to verify that, but I just thought about that. Like, if that's right, it's only 28 days, then the market really, I'm not a crude oil storage expert, but we can store it longer than 28 days. So it seems like that is kind of a short time period.
Yeah, if we thought about it like that, I do think oil prices would definitely be higher.
Yeah.
But that takes into account like all the SPRs, right? Or we don't know.
Yeah. And see, they didn't get into what makes up the 28 days. They just said that there's 28 days in storage right now, and regardless of where that number, if that's floating or SPRs or whatever that is, I just found it interesting that if that number's right, that a large portion of the oil at least is only 28 days. Yeah, that means that you could theoretically see the price fluctuate a little bit more. Of course, put my tinfoil hat on. Maybe that's what the traders want. They only want it to be around 28 days so they can make the price.
Yeah.
They can make the price move. If you had a year's worth of storage sitting out there, the price really wouldn't ever move.
Yeah. That makes sense.
There would be no reason for it to move. You've got a year's worth of storage.
Yeah. Meanwhile, Aramco is like, draw down the stocks.
Prices moving. WTI was at 50 something the other day, or 51.
God, so low. Yeah.
Got a little low. It's rebound some. But this is kind of this last article I was talking about. If Aramco's talking all this IPO talk, and we're seeing prices in the 50s for WTI and high 50s, low 60s for Brent, they must have some reasonable explanation that this is going to turn around.
Well, I think that the company isn't necessarily like so gung-ho on this IPO, and that it's being the government. Okay. So, the company is like, we're ready when they are, kind of, sitting here twiddling our thumbs. just pumping oil, making money.
Well, you are seeing, though, a lot of talk. No breaking news here, but rigs coming off the market, a slowdown out in the Permian. So it's not. The production takes a little while to follow. The production decreases. Of course, we got to figure out what's going to happen with the ducks. Who knows? But so theoretically, you could see the market kind of rebalance itself, if you will, go a little higher next year, especially if by the end of this year prices are still soft, the inventory is still kind of flush. Permian producers probably won't be looking to add rigs, so you might see it where mid-year next year, the price could be potentially higher. The IPO won't be done by then, but the price could be up at least.
Yeah, it's totally possible. Like I said, oil prices are that mythical unicorn that, can never really predict. I would not be surprised. There's people who are still saying we're going to hit 80 this year. So, and I'm not laughing at them because you never know. Look, we could.
I'm going to laugh.
You're going to laugh? Okay, we're not going to hit
80. Okay, I'll tell you what. If we, is this Brent or
Maybe
WTI?
I'm not laughing at them because I'm just too nice.
Okay. Is this Brent or WTI?
I think it was Brent.
Brent. Okay. So we'll say 70 WTI to make it fair.
Okay.
If we hit 70 WTI by December 31st, 2019, I will...
We eat your hat.
I'll give away a $500 Amazon gift card to a listener.
Wow.
How about that?
All
there
right,
it is.
Listeners, this is it.
This is me, and I really want to give it away. So I really want to give it away. I really want to give it away. Trust me.
Right.
I work in the business, so it's good. If oil hits WTI, $70 for just long enough for it to register on the ticker.
Just has to hit it.
It's got to hit it. They got to stay. $500 to a listener. We'll figure out how to give that away at some point. So Brent can go to 5,000. That's not included. 500 hard bones Amazon gift card or Visa gift card, some kind of gift card that you could spend wherever.
Amazon works.
There it is. So
all right,
that's how
guys.
confident. Which means it will definitely hit it now because I'm so confident it won't. It will definitely hit it. Am I in trouble, Ellen? Because you're not. You're laughing. You're laughing now. So
I'm gonna come to you to pick numbers next time I get a lottery ticket.
Okay, let's talk quickly about. Let's try to forget that. Hopefully, Nate cuts that out of the recording. Let's talk quickly about the Lebanese companies that are shipping Iranian oil to Syria. What is going on here?
This is very complicated, but some really good sleuthing by tinkertrackers.com and our friends over there that have been really tracking this stuff and trying to figure out, despite the fact there are all these sanctions, how this Iranian oil is actually getting to Syria. And it involves a whole bunch of ship-to-ship transfers between various ships. But yeah, that oil is getting there. And I definitely suggest that our listeners take a look at this article and at some other stuff that Tinker Trackers is doing, because not only is it really fascinating in terms of how oil is moving in today's market, but it kind of reads like a little bit of a spy drama. So it's interesting.
Yeah, and they've got a good chart here. It's like arrows that are going back and forth in ships. And if you just kind of glance at it, you're like, wait, does this actually work? And then you kind of get in there, you're like, okay, I think then you're like, okay, I'm not sure. It's pretty complex, but it has to be. I mean, what other option is there?
Yeah, but there's some really interesting stuff, and if it's going on there, it's probably going on elsewhere. So
yeah, and it's no surprise we've been talking about it for a while about the oil. The Iranians have to get out, and so it's almost they don't really have a choice, do they?
No, they don't. And I think that when we see reports of, where Iranian oil, how much Iranian oil is being shipped, we need to be skeptical of that because these are really complicated maneuvers that are going on and it's difficult to track. And there is more oil getting out there than I think a lot of people are aware of. And
once again, our monthly conversation with Dr. Dean Foreman, the chief economist at the American Petroleum Institute. It is that time, Ellen. Looking forward to it. And Dr. Foreman, I got to say, I read this line 2, maybe 3 times to make sure I'm reading it right. Am I reading correctly that U.S. petroleum demand was its highest since 2005? Is that? It feels like that should be a typo, but is that really what's happening here?
Hi, Ryan. Hi, Ellen. Actually, it is. For the month of July, 20.8 million barrels per day of demand in July, total petroleum. So pretty phenomenal month, actually.
It was. Did you kind of see this coming, or was this kind of out of left field? What were some of the things that pushed us to this, was it 14-year high?
What's interesting is that it's a mixture of bright spots and weak spots. When we look at gasoline and diesel fuel, kind of your bread and butter motor fuels, diesel's flat, gasoline's actually down, but yet here we are on a total demand basis being in pretty good shape. And this is coming down to the fact that in things like jet fuel and especially in refining and petrochemical activity, there's naphtha and gas oil, a lot of other oils. Those are also up. So it is a relatively strong picture on balance.
One of the things that we talked about, I believe it was last month, was trucking, and you talked about trucking was either flattened out or on the decline. And I was meeting with someone yesterday or this weekend, and they said that I was asking them about their opinion. They're in kind of on the ground floor of the trucking business. They said they haven't really seen that yet. What can you kind of walk us through where we're at with those indicators? Are you still kind of seeing those trends, or has maybe the tide turned on that?
I think we're still working through it. I mean, you had the agricultural issues a few months back, but seasonality aside, there are indications from multiple trade press sources showing by multiple indicators that the trucking sector broadly has been in a recession. So, look, there are certain sectors that are still highly in demand. There's no question about it. And the structural shift in our economy toward more in retailing, Amazon, online shopping, all of those things require shipping. So whether the good's going by truck to a brick and mortar sales facility or whether it's being shipped to the end user's home, ultimately you are using fuels to try to deliver goods at the end of the day.
Sorry about that momentary lapse. So I was looking at the report, and I was hoping you could talk a little bit about where we are in particular with jet fuel, because we've talked about jet fuel being this, being this strong kind of indicator. I myself had occasion to take a bunch of plane trips this summer. Airports definitely seem packed to me, but what do I know? That's just one tiny data point. And it says here we have record jet fuel demand. Do you think that this is seasonal and is going to calm down soon, or are we really just on a trajectory to see higher jet fuel demand?
Ellen, it's a fantastic question. It really does contrast with what Ryan was asking about, which speaks more to the industrial side. Whereas we've seen continued repression or weakness on the industrial side, the consumer side of things in terms of consumer sentiment and willingness to travel, especially by air, has continued to remain relatively bright. So the International Air Transport Association looks at the United States, North America as a whole, and globally. And whereas some of these trends have really weakened on a global basis, especially in North America, the revenue passenger kilometers have continued to be growing, but not growing as fast as they were. So it is this sense that jet fuel, you're right, it is a great contemporaneous indicator of what's happening in the broader economy, but we're also seeing solid growth, record demand for the month, again, over 1.8 million barrels per day of just jet fuel in the United States. We can question how far these trends can go and diverge, if you will, where you have relatively strong consumer activity but weakening industrial activity. We could even go further and say, is one a leading indicator of the other? But right now, that as it coexists in our data, we're seeing this divergence, and we're grappling with how it will play out.
But one of I'm fairly familiar with the seasonal demands when it comes to gasoline, and when gasoline demand is stronger and summer driving season. Does air travel have a similar? Do we see a similar seasonal pattern? So when we look at how fast or whether the demand growth is slowing, do we need to take into account the kind of seasonal variability?
Historically, that's exactly right. And in our monthly statistical report, we do show an historical chart where you can see a 5-year range of the seasonal patterns. And even if we go back just 1 year to 2018, we saw a lot more seasonal variance in the demand estimates. This year, it's been almost a straight line. It's been increasing toward a peak in the summer months, and then we'll see how the rest of the year plays out. But it is interesting that it's been deseasonalized this year, and it's just been kind of solid across the board.
Very interesting. I wonder if that has more to do with like deals offered by airlines or just a real need to travel. Maybe more people are taking advantage of lower airline fares. I feel like there's more to that issue to be explored. So what can you tell us about our favorite economic indicator, the distillate economic indicator, and where it's been and where it might be headed?
Thanks. Well, as you know, this is a combination. Our API economic indicator, the DEI, is a combination of things about diesel fuel, including the demand for it, the stocks, the change in those from a year-to-year basis, but also has some price and financial data going into it. And it's been a really strong spot-on indicator of where industrial production and general economic growth have been headed. And since we started publishing this in December, it's been signaling continued slowing. Now, this month, for the first time, the reading for July was zero. It'd be very, very slightly negative, but basically zero. And that says, because it correlates roughly with the year-over-year change in industrial production, that suggests a pause, but the real correlation with industrial production and the change of it prospectively comes on a 3-month average basis. So we start to average it over a quarter and then make a comparison. And on that basis, it's still indicating contraction, so negative 0.2 with the reading. And that suggests that this trend of industrial production having slowed as it has since December should continue, at least for now, and we'll have to see what happens. The macro picture plays into this, and it is interesting that if there's a silver lining in all of this, it's that despite these monthly declines, when we look year to year for diesel fuel or distillates as a whole, it's basically flat. So here, if we look roughly at the fact that the U.S. economy has continued to grow, but that growth has slowed from where it was 1 year ago. Despite lower fuel prices, here we are basically with flat diesel demand. And if that's your strong indicator of where the economy is headed, this is perhaps validating that the economy is slowing a bit, and we'll see how it plays out the rest of the year.
So since we've covered the demand picture right off the bat, let's turn to the supply picture. And we had a bit of slight, it says here that the U.S. produced a record pace of 12.0 million barrels per day year to date. Tell us about that number. Unpack it for us.
Well, 12 million barrels per day, it's world leading in terms of crude oil, and we've got another 4.8 million barrels per day of natural gas liquids on top of this. So it's big supply growth, and it's supply growth year to year for the United States as of July of 1.3 million barrels per day. Now, keep that number in mind, because if we look at the U.S. Energy Information Administration, the EIA, or the Paris-based International Energy Agency, the IEA, they've recently downgraded their estimates of global oil demand growth to respectively for the EIA to about 1.0 million barrels per day, just one, and for the IEA, it's 1.1. So that means the U.S. is supplying by at least a couple 100,000 barrels per day, more than all of the global oil demand growth. Whatever we may look at in terms of perhaps slowing trends or pressure with prices being down for West Texas Intermediate, prices being down 19% year on year as of July, we're still seeing really strong production growth in absolute terms, supplying all of the world, plus compensating for the fact that OPEC, as of June, was down close to 2 million barrels per day year on year. So it's not offsetting all of OPEC's production cuts, but it's certainly coming to OPEC at the cost of its market share as the U.S. continues to grow here. So I hope that helps in terms of unpacking it a bit. We could talk more about the details in the pieces if you'd like.
Well, let me just ask this question. This is kind of the redneck moment here of the show. One of the things as I as I look at this report that's really fascinating to me is, and I think hopefully this will make sense, is if you look at it, and the listeners will see this on Thursday, it'll be coming out, api.org, you put on all your charts the 5-year average. And what's fascinating to me is that I don't know what percentage, but I'm going to say at least 50% of these charts closely, all of the indicators are either south, depending on if it's import, or north of the indicator, to use that kind of term, it's the export, or outside or on the fringe of the 5-year average. Walk us through how important maybe the 5-year average is right now. I mean, I understand why you guys usually might want to unpack that for listener, but is the 5-year average almost, I don't want to say obsolete, but maybe not the best indicator? And are we kind of stuck in a spot where we're looking at stuff for oil and gas that the market's changed so much since 2013, 2014 that we're looking at 5-year averages, but the market in 2019 is just not what it was in 2014. Can you unpack that and how we should look at these charts? Because you look at some of them, you're like, oh my goodness, we're way outside the 5-year average. And then you go, well, all the things that's happened in 5 years, that kind of makes sense.
Well, that's good feedback, Ryan. I would suggest on the demand side that the 5-year average is highly relevant in terms of trying, because you've got those seasonal patterns that you're trying to unpack. And then, when you're thinking in economic speak of what's happening with economic growth netted against changes in prices, it is kind of useful to be able to benchmark it against the recent past, especially when you're talking about imports and exports. You're right, there has been a structural shift there with the ramp up in exports, and showing that over time, the only thing that you might lose is the fact that we've grown so much in terms of the exports. And it's interesting, in this month's report, we've had the second largest decline actually in oil exports as a nation. When we look back all the months and try to find something larger, it's really quite substantial that we lost 800,000 barrels per day of exports in July. But to keep that in context, we're still up more than 1 million barrels per day. Right. So year on year, it's sort of, there may be some seasonality or other things that are affecting it from month to month, but it's still a really solid trend. So, and then when we turn to things like stocks, it is kind of classic to continue to look at the 5-year band there too, to be able to grade it, and the market also tends to read it that way. So especially on the trade side, I think you're right. Maybe we could just show that over time and start to unpack it a bit more. I wouldn't want to lose perspective on the fact that these are continuing to hit really high levels, though, especially year on year, and that year on year difference really pops when you look at it in this format.
No. I'm not being critical at all. I think it's a way that people are used to seeing the data. I'm just curious. I guess more what I'm getting at is that the market has shifted so much over these 5 years that it's kind of like, well, this is, back in 2014, this is what things were like, but now they're just so radically different. Like, as you mentioned, the crude exports, we're way above that, and that makes sense from where we were 5 years ago. And so it's kind of stunning when you stop and you think about what the 5-year average range means, and then you think about where some of these numbers are. It's really kind of shocking. And then when I go to the inventories, we're on the top side. I think it's a 4.1% below the top of the 5-year range. And my same question there is should we, as we go forward in the future, the historical, how much oil we've had in storage, should we expect the number to be a little bit higher than what it has historically been just because of the increase in production?
I think that's about right, but we also have to keep in perspective how much storage can we hold, and how is that form of storage, whether it's floating storage or storage tanks or caverns. When we're doing this, we're looking at private storage excluding the strategic petroleum reserve. So by and large, this should be what the system can manage. And the market financially tends to respond with weaker price action when it sees those inventories really building up. And that is, when we look at the net of supply and demand, where it really comes together is looking at that change in inventories. And that's why the API inventory report that comes out, our weekly statistical bulletin each Tuesday, tends to move the market. Those are really important as kind of pulse indicators on the trading side. Here with the monthly statistical report, we're trying to zoom out a bit and see what we can discern as to larger trends and relate those back into the economy. And what it tells us right now is that, look, we've had really strong supply growth. We've had demand growth that's still solid. And net between the two, it suggests with that building of overall inventories that the supply growth is trumping or outpacing the demand growth just a bit.
Yeah, and then my final question is, we have seen, and you guys allude to it in the report here, it seems like every day there's an article saying that the demand growth is going down. But and part of that is because of what's going on with President Trump and the Chinese trade war. Also, though, one of the things that's it feels like it's being left behind, I think because folks don't really know where to gauge it as is that producers in the Permian especially, we saw in Oklahoma as well, they're pulling rigs off. They will be pulling rigs off towards the end of the year. Depending on where price ends up at the end of the year, they might not put those rigs back on the first half of next year. Of course, we have the DUCs, the famous DUCs. We got to figure out what's going to happen with those that we won't know for a while. But as the trade war progresses and there's no end in sight, at least today, but you also see that the U.S. Permian producers should eventually the production should slow down at some point. Will that give the market a little bit more ease by maybe, September, October, November, rigs start coming off? At some point, the production numbers go down. So even though demand forecasts aren't great, the production at some point from the U.S. standpoint, it might not match it 1-to-1, but it will come more in line. Do you think that will give the market a little bit more ease as we look for these reports over the next few months?
The EIA's view in terms of production growth is that pace of growth should slow over the course of the year, but the absolute level of production for crude oil should go from this 12 million barrels per day up toward 13. Now, with the backsliding of a couple 100,000 barrels per day this last month in July and by API estimates, and frankly, as you just highlighted, some pullback in drilling activity, and the drilling activity, there's still a time to market. So we should start to see in the next couple of months that's going to show up in our crude oil production data. It's not a surprise with this environment that you'd see some pullback in drilling activity. And as the infrastructure is expanding, as you just mentioned, those drilled but uncompleted wells can be brought to market. And for 3 consecutive months, EIA is showing that the number of DUCs, so to speak, has continued to come down. So that says production is going to come. The question is how much, and we should expect that growth to slow off of this really strong base. We can't micrometer it, but it does look like solid production trends we're seeing actually after we highlighted it in June that we have this potential approaching constraint in terms of crude oil export capacity for the United States. There are more articles now about that, and that is actually becoming a hotter issue that's going to have to be worked sooner than later.
Yeah, what I was going to mention is we had on someone from Cryos, I believe it is the firm the other day, who they're saying that there's about I don't know, is it 50% or 75% less DUCs out there than actually being reported by the EIA. So I am, as the perennial DUC agnostic on the show, I am curious to see where the DUCs actually are, how many come online. That to me, that's one of the topics that it gets talked about a lot, but I'm really curious to see how that pans out, because if a lot of DUCs do come to market, like you talk about, that's one scenario. But if they don't, for whatever reason, that's the thing. And as you know, as you think about the DUCs, we don't know what the motivation for the producers to bring the DUCs necessarily are. Each producer has his own, and what will make them want to do that is kind of up in the air. So it's going to be interesting to see what happens with all that. Dr. Foreman, is there anything that we did not get to that you wanted to highlight before this report comes out on Thursday for the listeners?
You've asked great questions. I think we've covered most of it. It's a really interesting month to make sense of it, in the sense that prices jumped up close to 5% in July, but yet we're down close to 19% compared to July a year ago. And the mix, when we kind of keep it all in perspective, we have to try to separate the wheat from the chaff and really look at what's the underlying trend here. And those year-to-year comparisons tell us a lot more, that structurally we are almost 20% lower in price. And that's technically a different operating environment for the industry than it was a year ago. So again, watch this space, see how the economy and the economic expectations play out, because energy demand as a whole and oil in particular tend to go hand in hand. right now, the expectations have continued to not only slow for this year, but the thing that's maybe interesting that's not actually in this report is that there's an increasing expectation in the Bloomberg consensus of a divergence between world growth and U.S. growth, where U.S. growth is continuing to slow, and they see a rebound starting next year in world growth. That could be wrong. The consensus isn't always correct, but if that plays out, that has implications in terms of the U.S. dollar and historically in terms of crude oil prices. So watch this space.
Well, Dr. Foreman, we announced it earlier today. We will give you thanks. iTunes just updated their rankings, and this show, they have 60 shows ranked in the business news category, and this show is number 56, I believe it was, or 54. So, but guests like you, we thanked our listeners. We didn't thank our recurring guests, and you are one of them. So thank you for being part of the show and helping it grow. We do appreciate that. Anything else? API.org is where they can go. Anything else we need to plug or promote before we get you out of here today?
No, that's great. Thank you so much, Ryan Ellen, for having me. I really enjoy speaking with you each month.
Okay. And again, API.org, top right, Chief Economist is where you can sign up for that. Thank you, sir.
Thank you. And follow him on Twitter, too.
Thank you.
Now that you're on Twitter.
Awesome.
And once again, that was Dr. Dean Foreman, Chief Economist at the AP. Ellen, good discussion and a lot in this report. And I'm still blown away that the demand was that high. Like I wouldn't have, with all the woe is me articles coming out, you just wouldn't have expected to read it. Like if the report would have said the demand was the lowest since July of 2005, you'd been like, well, the trade war, this, that, and the other. But to see the opposite, it was just kind of stunning.
Yeah. And, what's interesting, I should have pressed more about the exports, because I remember reading, like maybe it was yesterday or the day before, that some pretty big, like a big Chinese super tanker was just filling up in the loop, and there's some other ones. So like, I mean, maybe our oil exports are going to be picking up in August. So keep an eye on that.
Maybe if two people could sit down at a table and work out a trade deal, maybe they'd pick up too. Just throwing that out there, just JS for those who might be listening. Okay, Ellen, you obviously have a piece that you released right before you came on the show today, I believe.
I jumped. I'm going to admit I jumped the gun just a tiny bit on that, and it has some like bad typos I need to fix. So don't read it until I do that. It will probably be fixed by the time this podcast comes out. But
it's not considered an editor's select or whatever just yet, so you're okay. The masses.
My editor is on maternity leave, so. Hopefully she is busy with other things and not reading my articles. So,
okay. Well, luckily for you, I have the grammar of a third grader, so I wouldn't know if you had it wrong or not. The listeners are much smarter though; they will get you. Okay.
I like getting text messages. Do you this. I'm like, okay, well, good thing I didn't close it, but I'll fix it. Not now.
Okay. So Forbes, you've already released one. Investing.com, I presume, on Wednesday. Anything else?
Yeah. Let's see. I was on Bloomberg Radio earlier on today, which is Monday. I will put that out on Twitter for those who want to listen to that. It's like a 6-minute segment about the Aramco investor relations call, and that about does it for this week. So I don't know. We'll see.
Okay. Text Oil and Gas Podcast, Oil and Gas Contractors Connect, bringing the closers with Ben Samuels. I think that's it. I'm here on Energy Week every week. We're good. We're back. We will be back until Labor Day, I suppose. We'll probably take off that Monday, but we're back in the saddle, watching oil demand go up and down, watching Iranian ships going this here and there and everywhere. So, Ellen, it's good to be back in the saddle, and we will talk to you, everyone, next week.